Kevin O'Leary is a businessman, investor, TV personality, most commonly known from the show Shark Tank. And in this video, we're going to go over the top 5 dividend stocks in his portfolio. Kevin O'Leary, also known as Mr. Wonderful, is a highly respected investor. His estimated net worth comes in at over $400 million, and he also runs a company called OUSA ETF Investments. They have various ETFs on the market, and the 3 most popular are ticker OGIG, which is a global internet giants ETF, ticker OUSA, the one we're going to focus on today, which is the US Quality Dividend ETF, and he also has a ticker OUSM, OShares US Small Cap Quality Dividend ETF as well. So in this video today, we're going to go over Mr. O'Leary's, Mr. Wonderful's top 5 dividend paying companies, discuss what they currently trade at, the current dividend yield, future dividend growth, and of course the dividend safety score for each of these 5 companies. I actually own all 5 of the stocks that are in Kevin O'Leary's top 5 holdings. So what we're going to do in this video is break down the ETF OUSA, the US Quality Dividend ETF. It is up more than 50% on the 5-year chart. It has around 600 million assets under management, pays out a current dividend yield at 1.6%, distributes monthly, and has an expense ratio at 0.48, which is on the high side compared to some passive index ETFs, but is in average rate for an actively managed fund, which this is. So this ETF's philosophy is to invest in high quality, dividend paying companies that have strong balance sheets and strong free cash flow. So what that means is these companies will be able to sustain operations and grow that dividend for many years down the road. And Mr. O'Leary himself has said that this fund makes up a majority of his net worth and a majority of his investment in the stock market, because this fund is a little bit more on the conservative side. They cap out each holding to a max of 5% and each sector of the market to a max of 20% of the ETF's fund. So it's nicely diversified. You have some market leaders that have some strong balance sheets, and the balance sheet shows the representable health of a company. And if they have a strong balance sheet, very unlikely that the company will go down anytime soon. And these are the safer, more blue chip names that you can find on the market today. So if you're new to the channel, everyone, I am the Gen Z Investor, and every single day we talk about the stock market. We go over different stocks you can buy and sell within your own portfolios, and of course, we go over any stock market major news or headlines. So please like this video, subscribe to the channel for daily videos about the market, and we're going to break down the top 5 holdings in Kevin O'Leary's portfolio from the ticker OUSA. The 5th largest holding in Mr. Wonderful's portfolio is Merck, ticker MRK, the healthcare giant that currently trades around $83 per share. They are down more than 7% this year, but over the past 5 years, shares are up over 53%. This company has a market cap at around $208 billion, currently yield 3.15%, trade at a forward PE of 13.8, and trade somewhat towards the middle on the 52-week range. I bought into this company earlier this year for around $75 per share. And if we take a look, Merck is expanding, and they just made an acquisition for around $425 million to buy out a company that has control for a potential drug in a vaccine. So they just struck a deal to buy a company that will give them full control of a fusion protein linked to improvements in clinical status in a phase 3 trial of a severe vaccine to help solve the pandemic and get us back to normal. Merck is a leader in the healthcare sector, and they're estimated to continue to grow for many years down the road. This is a very stable blue chip company, and you can take a look right now. They are yielding 3.15%. They only pay out around 43.5% of their earnings as a dividend, leaving them a lot of room to continue to grow that payment, plus reinvest back into the business. They grow their dividend at around 5% per year over the past 5 years, and they have a 9-year dividend growth streak. And if we take a look, they have the highest dividend safety score possible. Coming in at 99, the dividend is considered very safe, and absolutely no worry or no expectation of a dividend cut coming anytime soon from ticker MRK. Moving on to Kevin O'Leary's 4th largest holding, we have ticker PG, Proctor Gamble. This dividend king has been successful for decades and is expected to continue to grow for many decades down the road. They currently trade for around $138 per share, and the company is up more than 10% this year. They have a market cap of $341 billion, a current dividend yield at 2.3%, forward PE at 24.76, and have seen a pullback away from the 52-week high. And Procter Gamble is a company that has performed extremely well even throughout the pandemic and the shutdowns. They provide consumers with essential products that are always going to be in demand regardless of what's going on in the world. and they even raised their fiscal year 2021 guidance even during this pandemic. During a point in time where a lot of companies are reducing their guidance numbers or not even giving forward guidance because they're unsure what's going to happen, Procter Gamble came out on their latest report and actually raised guidance expectations for the next year. And if we take a look at some of their key brands, they will operate regardless of what's going on in the world. They operate in 10 different sectors of the consumer market that are all necessities. Feminine care, grooming, family, hair care. All these are market-leading brands that dominate our shelves at stores. And this is a company that no matter what's happening in the world, their products are always going to sell. So I own this company in my portfolio as well. I'm a strong believer in this company long term, and it is the 4th largest holding in Kevin O'Leary's portfolio. They currently yield 2.3%. They pay out around 56% of their earnings as a dividend, and they grow their dividend at only 3% plus per year. So not a ton of dividend growth from this company. It's been around for decades and decades. Their dividend streak is at 64 years, making them a dividend king. So it just shows that during good times and bad times, they will continue to grow their payment. It may not be a lot, but your dividend is at least matching or slightly outpacing inflation each and every year from Procter Gamble. And they are still coming in with the highest dividend safety score possible at 99. So again, another company, very, very low risk of a dividend cut coming anytime soon. And I don't think we'll see a cut over the next decade because they just provide such essential services that they will continue to grow in demand as time goes on. Moving on to the 3rd largest holding in Kevin O'Leary's portfolio, we have the Home Depot. Ticker HD, currently trading right now for around $260 per share. This is of course the market leader in the home improvement warehouse retail space. They currently trade right now at a market cap of $282 billion, and shares are up more than 22% this year. Over the past 5 years, shares are up more than 96%, and they currently yield 2.28% with a forward PE of 22.2. And this company has seen a record surge in sales as people are spending more time at home. With the lockdowns and the forced stay-at-home economy and people spending more time working from home, they are spending the money to improve their living space. Because they're spending more hours in a day at home, they're spending the cost to actually improve it and make it more livable. And Home Depot sells the products and the services to do just that. And you can see they've announced record-breaking sales as demand for DIY projects has absolutely surged during this new time we're living in. And if we take a look at this company, current yield at 2.28%, a payout ratio of only 50% of their earnings. So very sustainable. We can see that dividend continuing to grow, plus Home Depot has enough money left over to reinvest back and grow the business. They have a 5-year dividend growth rate average of over 23%, which is absolutely ridiculous. So you're getting a company right now which may be considered a lower starting yield at 2.2%, but that dividend is compounding rapidly at over 23% per year over the past 5 years, which is absolutely incredible. And of course, like all the companies on this list so far, a very safe dividend coming in with a score of 87, so absolutely no worry about a dividend cut coming anytime soon. These are companies with strong fundamentals, strong financial statements that will continue to grow the dividend for a long term down the road. Johnson & Johnson is the 2nd largest holding in this high quality dividend portfolio. Ticker J&J is up around 6% this year and currently trades for around $151 per share. Over the past 5 years, the company is up 44% and currently have a market cap at $392 billion, making it one of the largest companies in the S&P 500. So we all know Johnson & Johnson. We all know how strong they've been. This is a dividend king that has dominated the market over the past 50 plus years, and that growth is expected to continue to come for years down the road. Of course, we're not going to see any tremendous growth from J&J, but a very stable blue chip company that pays a very safe and growing dividend. Current yield at 2.7%, and this company is operating within the vaccine space as well. They are confident that they will have 1 billion doses ready for the vaccine over this next 2021, and they are already looking forward to the next year in 2022 to plan for that calendar year to see what they're going to do regarding the vaccine and their other medical devices. And if we take a look at that dividend, the 2.7% current yield, again a company very sustainable payout ratio at only 50% of their earnings, and a 5-year dividend growth rate of over 6.3%, which is beautiful, and this company's dividend growth streak is at 58 years, again, one of the largest streaks on the market, making this a dividend king. And again, another company with a 99 dividend safety score. Absolutely no worry about a dividend cut coming anytime soon from Johnson & Johnson. And coming in at number 1, the largest company in Mr. Wonderful's portfolio is Microsoft, currently trading right now for $216 per share, up 41% this year, and over the past 5 years, shares are up more than 283%. Current market cap at $1.62 trillion, and of course, this is one of the largest companies in the world that has seen tremendous growth this year, and that growth has not been slowing down whatsoever. They currently yield to 1% with a forward PE of 31.7. They have seen a slight pullback away from the 52-week high, and overall, we all know Microsoft. It is my second largest holding, and I'm a complete bull at this company at really any price point. I buy into companies that I think are going to be larger than where they are today over the next 5 years. So I think Microsoft is still going to be a market leader 5, 10, 15 years down the road, and they continue to innovate to meet market changes, and I think that's what's really going to help them set them apart. They have some of the best financial statements in the world, a beautiful income statement, beautiful cash flows, and an absolutely stunning balance sheet with over $100 billion of cash just sitting there ready for acquisitions and for future growth projects. And if we take a look, their cloud platform has absolutely expanded, growing more than 48% year over year over the latest quarter. The Azure platform is meeting huge demand, and as people are working remotely, it is only growing in popularity, and they are the market leader in a growing space that I think is going to really be a key revenue driver for the business over the next decade. So of course, the dividend yield is lower at only starting at 1%, but the company's payout ratio makes up 33% of their earnings, so extremely safe and sustainable, and they have a 5-year dividend growth rate average of over 10%. So of course, your dividend starts out slow, but it compounds nicely, averaging 10% growth. They've been doing that for 17 consecutive years with absolutely no sign of slowing down for any years down the road. And of course, their dividend safety score, like many others on this list, was 99, so very safe, no worry of a dividend cut. So now that we're going to go through the top 5 holdings, we saw these are all beautiful, high-quality dividend companies. We saw 2 healthcare names, 2 consumer names, and a tech brand. And we all know these companies. They're all blue chip. There's absolutely no surprises, but these are the top holdings in ticker OUSA, the Quality Dividend ETF. I'm a big fan of these companies, and I actually took a look at OUSA, and I own the top 8 holdings of this fund in my personal financial freedom portfolio, which just reassures that my investing philosophy, I'm not a risky type of person. I like quality, I like stability, and I like long-term growth. And those are the companies I hold, and it really reassures me that all my top holdings, my 8 holdings in my personal portfolio, also match the top holdings in Mr. O'Leary's, Mr. Wonderful's, the world-renowned investors' top 8 holdings as well. So this was a quick little overview of Mr. O'Leary's portfolio. He's well respected, famously known from Shark Tank, where he gives his brutal, honest opinion about these small businesses that he plans or is pitched to by different owners. And I think he's a well-known personality. I personally really enjoy him on the show and in other TV shows, and he goes on for interviews and discusses the market. I overall like his personality. I like how he's brutally honest about what he's saying, thinking, and I do think this was a great video to kind of go over some quality companies with stability and strong dividend growth rates. Thanks for watching. See you in tomorrow's video.